This episode is sponsored by Sir Lancelot LLC, also known as SLA Capital, which, if you didn't know, is Dan and I's private lending company. So yes, we are sponsoring our own show, but what you going to do about it? It is our private lending company that offers hard money and DSCR loans to real estate investors of all types. So you can be a new investor, an experienced investor. You can be buying flips. You can be buying rentals, whatever. We can do everything. And not only that, but the rates that we offer are just as competitive, if not cheaper, than pretty much every other company out there. So whatever big company you've been working with, bring us their term sheets and I guarantee you that we can probably beat it. We have the same connections they do. We just don't have all the overhead and middlemen. So if you want to come and check us out, go to slacapital.com/keys and I will know that you came from the show. And by seeing that you came from here, when you get to closing, you will save $500 on your first loan with us. So slacapital.com/keys, we would love to fund your next deal. So is this like the moment that we're going to remember when the next like Big Short movie comes out in like 2 years?
Which is in Vegas. That scene is in Vegas. Yeah.
Which is, that scene is in Vegas, dude. And she's like walking through like how they have it. They're having all these like shitty loans that they're now going to do. And I was like, what is happening?
And then Sunday night, I thought that I was going to win the bet, and then we didn't. So
yeah, I was thinking maybe I was going to go to Thanksgiving, but then it did exactly what I was kind of expecting, where as soon as the elections were over.
Oh, wait, you're saying it was just political fodder that some people maybe got into binds because of their politics?
No, we don't have political fodder in this country, Dan. Everything here is very, very legit.
Good thing is it kept poor people poor. And politicians gaining power and wealth. I don't know.
What's going on, guys? Welcome to the Collecting Keys podcast. I'm Mike DeHaan here with my co-host Dan Austin and Dylan Cook. And it's funny talking about politicians getting rich. Dan, I saw this meme and it was like the world's best hedge funds, 30% on a great year. Nancy Pelosi, 67%, 17 years in a row.
Seriously, though, like she's taking the brunt of this. You know, I almost feel bad, except for I don't. But there are a lot of those politicians in there that are doing the exact same thing.
You should definitely not feel bad about anything with these people. Because also, too, it's the ultimate position of like they're putting themselves in the limelight to do nothing except receive criticism for every single thing that they do. Like that is a voluntary position. If they wanted to be just a normal, average, corrupt, rich person, don't go into politics. There's lots of other corrupt people that do the same shit. They're just not in a position where they can be scrutinized for every single thing.
Yeah, but that's why you go into politics.
Totally.
Because you can't do it any other way.
You got to be the politics friend. Politician's friend. You know, then you're at least 1 degree removed.
But that means you have to provide something. You got to provide something. And politicians provide nothing and then they get something.
You have to create value.
They provide information and then they just put some back into.
Yeah. God. Anyways. As it goes. But either way, shutdown's over, guys. So I hope you guys enjoyed your shutdown over ending parties. The universe did. It had the Northern Lights. It was like across the entire United States, apparently.
Yeah, we even had it here in Cincinnati.
Dude, they had it in freaking Texas.
Don't take it away from me. I'm just saying, it was nice.
Is that aliens?
Yeah, I would assume so. Like, I don't know what causes it. Weather, global warming, aliens, something. But it was pretty cool. If you guys have never seen it.
The heavens opened up because SNAP benefits were back.
Yeah, it also has to do with magnetism.
I don't know if you can like actually see it with your naked eye. If you go further south, in Spokane, it's very hard to see with your naked eye.
It just seemed like it was more bright out. I was in the hot tub last night with Cole, and it was just like brighter out.
Yeah, the only time we've ever actually seen it is in Iceland. I guess because you're so far north the way it is. But anyways, Dan and I were at a big private lending conference in Vegas the past week, and very applicable to real estate as well. It's because we're meeting with all of the guys who fund all of your deals, whether you know it or not. Regardless of what lending company you use, and if it's not SLA Capital, I don't know what to tell you. The people who actually give the money for your deals was at this thing. Like there was like the CEOs of every company, like the leaders of like the hedge funds that the big companies sell all their debt to. We're all at this thing in Vegas this past week. And you
know what's more fun than a real estate conference?
Finance conference, 100%.
Yeah. And the thing about it is, I like about it is nobody's pretending to be there to listen to the speakers.
100, dude, like shamelessly, like they're like doing the talks. There's like 15 people in there. Other dudes are like at the bar, at the casino, like networking, doing different stuff. Man, there's a big conference, like 900 attendees, I think they said they had planned to be there.
Yeah, it was like 900 people.
And it's totally not around like the conference piece. And one of the things that I think makes it so much more fun is that people in the finance space, they actually have like money, like hard cash. Whereas you go to the real estate conference, it's awesome. You meet like the old guy there that is worth $100 million. He only has 400 grand in his bank account. All the rest of the money's in equity. These guys don't have shit for equity.
But they got cash flow.
All they have is cash, tons of it. And like a lot of these guys, we sat next to a guy on the last night at dinner. He's like, yeah, we're pretty small. We do about 100 million a year in loans. And that's like a lot, just so you know. Like he's probably making $3 to $4 million a year. So owner of this company churns pretty well. And like it's a pretty systematized company once you build it out. It takes a while to get there. But there's just so much cash like in this space. You have people like that. And then you have other companies that are doing like 500 million a month, that are also there, that are basically the top people that everything's trickling up to. And it's a very much like a different vibe. But one of the things that was so interesting, that's always interesting to hear when you go to these things, is what the big money sentiment is around real estate as a whole. And this is all private lenders too, right? So they don't really care about like the commercial loans, the like residential loans, like owner occupant kind of stuff.
The Fannie Freddie stuff. It's all just looking at like what the private business debt is doing.
And we went to Nobu for dinner. If you guys don't know, that's like very, very expensive sushi place. One of our vendors took us there.
It's very nice.
And yeah, it was super nice. The total bill was, a few $1,000. It was pretty hefty, more than I'm typically going to be spending on a meal.
Mike eats a lot of fish.
You know what? Our sales team eats a lot of fish. Yeah. But we were there and they were telling us about some of the new loan programs that they have for investors. And the rep that we're there with, she's like, oh, let me tell you about this new thing that we're doing.
Oh yeah.
This like blew my mind. She's like, yeah. So we now have, they called it a rescue loan program. So we'll do like hard money loans for our floor credits, 500. You can have as many lates as you want. Basically, it just has to be up to 50% loan to value or loan to ARV of the asset. And she's like basically going through how loose they are. So they don't have to have money. They don't have to have experience. They can have 500 credit. And I said to her, I was like, so is this like the moment that we're going to remember when the next like Big Short movie comes out?
Yeah, right.
In like 2 years.
Which is in Vegas. That scene is in Vegas.
That scene is in Vegas, dude. And she's like walking through like how they're having all these like shitty loans that they're now going to do. And I was like, what is happening? Like, I feel like we are seeing a glimpse in history.
Doesn't bother her though, right? She's selling loans.
Totally, dude. And that's the problem.
Everybody's making money along the food chain.
They're almost like bragging, right?
Totally.
When they're selling this. Yeah, right.
Absolutely, dude. It was so reminiscent of that scene in the movie where he's going through and there's like, I think he's actually talking to a dude eating in a fucking sushi restaurant. It's probably in Nobu. And the guy's like, how about you show me your bank account and I'll show you mine, right? And he's talking about how much money he's making. That is fully how it felt.
Yeah, but the difference is it's like random people's money. It's private money, right?
Totally. That's the major difference is
the government's not coming in to save anybody.
There's a lot of these people that are backing these, the private mortgages that are getting wrapped up and sold. And like now these new like junk private mortgage programs, it is extremely wealthy individuals. A lot of them are from overseas. It's like hedge funds that are corporations, right? That are built up of private money that they've either raised, they've accumulated, whatever. And it's not these different banks and that are trying to sell it off to the government and do everything else like what's happening in 2008, quite the same. And so they're not using like consumer money. And so what the actual end situation of it is, I don't know. Because like, I guess worst case, like they all lose their money. And like, is that a bad thing? Like maybe.
Yeah. Especially because a big chunk of it is like foreign nationals. And on the higher level, it's like, I guess the positive outlook is like they're buying and investing in the American dream, like big Chinese funds that we talked to. And then like, we even talked to a guy who, I don't remember how much he had, but he's like, this is big in Florida. I've met 2 or 3 people now that have $80 to $100 million of like South American money, and they want to invest in Florida because, it's close.
Yeah.
If it remains international, you wouldn't think. I guess my thing is, if this is so much money, how big can it be so where it is systemic to maybe regional banks? Like,
yeah, it for sure could be at some point in time, right? Because there are some hedgies in there. I don't think that they have pension funds or anything like that invested in it, but they do have American tax dollar or American taxpayer money in them.
Of course. But a lot of it is overseas though, and so like one of the main funds that we sell our stuff to, they're backed by a bank out of Austria. And it's just like a large bank that's over there. When we did our onboarding with them, we basically get to see up their chain because essentially what some of the paperwork that we sign is our understanding that if they go underwater, people that we sell to, here's actually who owns the debt that we're selling. Right. And so we get to kind of like see that. And there's all these different tiers that are expanding so much further than just like the US balance sheet. It's really, really interesting. And then like the one I was talking about with this lady that's doing the junk bonds, it's like a guy's money. It's like a dude, according to her, not even like an old guy. He's 37 from Russia, right? And he has a shit ton of money. And he is using his own funds to create these private money tranches that he then securitizes and sells to bigger money beyond him. Okay. And so it's really, really fascinating. And I'd say it makes me realize how dynamic the financial piece actually is. And the thing that's so fascinating as well is that it moves, I would say, significantly faster than the real estate piece of it. Because like you're just pushing around paper. You don't actually have as long of like a lead time like you do with real estate. Stuff needs to stabilize and all these different things. And so versus the conference we went to in Newport Beach in August, there was like conversations that were completely different that were happening at this one in Vegas, just 3 months later.
Yeah.
But with the same people, right? But they're just working on different stuff, different kinds of money, different sort of like loan packages and offerings.
Everybody's scaling, it seems like.
Mm-hmm. And what you're starting to see as well is you're starting to see more and more private money get into stuff like land, get into commercial, industrial properties, those sort of things, which hasn't really existed that much in the past. This is the first time we've been to stuff like this, and I've actually seen some of these funds that are advertising that.
It sounds like it's a perpetual search for yield.
Exactly, 100%.
Oh, 100%.
Where is all of these people going to put some of this money?
Yeah, 100%.
Mm-hmm.
With equities at all-time highs.
Well, I always think there's so much money out there.
Yeah, but like there's a lot of money, but it has to find somewhere to go. And they're always going to look for the highest yield with the least return. Risk-adjusted return is the name of the game, right? And once you get to $100 million, there's very little things that you can invest in and scale. And debt is probably one of the biggest things you can do.
For sure. And so for us, our primary business with the lending company is origination, right? Like Dan and I, we have a small fund. We'll hold some of our hard money stuff and we have a little bit of money that we've raised. But at the end of the day, our goal is to kind of like sell off everything. All the DSCRs, we're obviously not carrying those in our balance sheet. And if you look at this, like this conference, almost everyone there was trying to buy the notes that we're originating. You know, there was very few people that are actually on the origination side. And so there is, I would say, a lot more money than hustle in the space right now because not a lot of people want to be building out a sales team, running their lead gen, doing everything else. But there's a ton of people that want to basically be the recipient of that. And I would say it's like on like the real estate end, that is from a finance perspective, it's like the same as if the real estate, the people that say like they go bigger faster. Because a lot of these guys, it's funny, they don't even have an incredible amount of experience originating loans or anything else. But their whole thought is like, if I can just find a bunch of people that can bring me the loans and I can carve off my 1% of $1 billion, that's more appetizing to them than generating a bunch of like $200,000 loans, right? Which makes sense, you know, and it's like a more sophisticated level to play in. But they're very similar to real estate where there's like the deal finders. That is absolutely a minority of people that are in the space.
The more that you guys start doing this, were you surprised at the level of middlemen? Like how many middlemen there actually are?
Yes. I didn't realize the level of tiers because like even like below us, right, we're direct lenders, direct originators. There's also brokers that aren't affiliated with anybody. And so they basically just go out and find people and then they would come to us to get it funded. And then you can basically become a correspondent where you sell loans to these different lenders and you kind of have their process entirely. And then you can basically go a step up where you originate your own and then you sell on secondary and market yourself. And then you can actually become the ones that packages it and sells on like the big market. So you're like, you are the secondary market basically. And between every loan, there's 5 or 6 people that it goes through before it finds its final resting place.
Yeah. I mean, that we know of.
The
way I think about it is there's originators.
Intergalactic bank.
Right. There's originators, there's platforms, and there's like aggregators. Mm-hmm. And like the platforms, you think of like a tech focused company where they're very tech driven to say, hey, we're going to create a platform that makes it easy to collect all of these originators' loans. They wrap those up, sell them to an aggregator who then at some point either securitizes or they go to a securitizing company that will wrap that up in $100 million tranche and sell it. That's kind of how it goes. A little bit. I don't think it's any more challenging at any level. It's just, it's all about who you know. So most of the guys that are aggregating loans or are on platforms, they've been in the industry 20 years and they are smart people and they were given an opportunity to start a company or they started their own company and they they had relationships on Wall Street or relationships at banks. We don't have either of those, but we have relationships with guys like you, Dylan, which it makes us really good at originating.
Yeah. So there's a ton of value on both sides, and then what you want to do is you want to be the best at one side. You just got to meet people that are on the other. And I think that's where a lot of people get stuck.
It'll be interesting to see, because turning it back to like the more government level, I mean, Powell said they're going to stop QT on December 1st. But what's different about that is the balance sheet at the Fed is basically comprised of different durations of treasuries, T-bills, bonds, treasuries, and also mortgage-backed securities. But what they're going to do in this next cycle is when they start QT is they're basically keeping all of the government-backed debt and letting all the MBS fall off.
Expire.
Yeah, right. So they're just not renewing the debt. And so I don't know, like people will say, yes, QT is happening, which means we'll have more liquidity because you're not drawing away from the balance sheet. But the composition might matter, right? Because if they're actually buying more short-term stuff, which is what they've been doing lately, T-bills, bonds, then they have an inverse relationship. So you would actually think that yields would go up the more that they're buying. I don't know what's all that's going to happen. I'm just saying, like,
when those bonds roll off, does that mean that the banks that issued them have to issue them at a higher yield?
You would think so.
Because nobody's going to buy them?
I would assume so.
Correct, because that there has to be a buyer. And this is where the whole leverage ratio comes in with primary dealers with banks, right? They got rid of that so that banks could have more treasuries. But when Yellen was in office, and actually Bessent criticized her for this, and now he's doing the same thing, is they took their treasury duration from like 15 to 30 years all the way up to T-bills. And that's just because of what the T-bills were paying. So now this debt maturity comes sooner, right? So what do you roll it into? You have to roll it into more T-bills. So I don't know. Again, I don't know how this plays out, but I think what everyone, they use their memory, like this is what happened last time. And all this happened, like the repo spiked back in 2019. Like, I don't think it's going to be the same outcome because the composition of what it is changing.
Yeah. It's hard to say. Obviously, we're getting into kind of like uncharted territory with a lot of this stuff where probably nobody knows it at a consumer level. Where it's going to be a challenging change of culture, is there's so many people that are used to monitoring what the Fed rates are doing. I think it's going to adjust mortgage rates, right? There's a whole industry with realtors and traditional mortgage lenders, things sort of like beating that drum. But I do think that that's going to be shifting away very, very quickly. And this is something, I mean, we deal with this on the DSCR side as well. And even right now, we have some of these borrowers that have come in and they're like, well, I'm going to wait for rates to go down a little bit more. I'm like, they might not, because they see like Trump talking about stuff or the rate drop or whatever. But like on the private level, it's completely different. And the only reason they're ever tied is when the actual end buyers of it are comparing the private yield to what they can get from U.S. bonds. But if they're no longer interested in U.S. bonds, then they're not going to be tied at all.
Yeah.
Basically going to be based off whatever price they're willing to pay.
Price, it really is the supply and demand at that point.
Supply and demand, totally.
Yeah.
Even at like just a tier above us, like when we generate our loans, where we sell them to, it's crazy how much it varies. We can generate a loan and we can be trying to sell it to 3 different people. Their pricing will vary by a whole % sometimes. Like there might be a loan that one company will buy for like 6.25 and another company won't buy for less than 7.5.
Or let's say your biggest fund that you sell to is like, oh, we met our quota for the month or whatever.
And we're done.
We don't want it. Like, well, fuck. But what we just, told our lender that they're going to get, or our borrower, I should say, is going to be totally different.
Yeah. We literally have one of those right now. That's almost exactly what happened. Is they basically were like, oh yeah, so we are up against the end of the month. There was basically all these like rate locks that came in. Like we can only really do like so much at these rates. It's like both on an underwriting perspective with their processing capabilities as well as their financial capabilities. And so we are having to prioritize who's actually going to get the rates that we promised them 30 to 45 days ago and who isn't.
Better be me.
Yeah. Well, yeah. Well, it's the people that were further along and those that have been easy to work with. So that's also a tip for you guys. Be easy to work with and get shit to your lenders quickly, because otherwise, if their end buyers change their mind and you're the one that's kind of like dragging your feet, it's possible they'll tell you tough shit. Sorry, your rates just went up.
Be easy to work with. Don't be a pain in the ass. Be cool too. I mean, we're getting preferential treatment by our buyers because they're like, well, you guys are cool. We went to a conference, met them, which is why you got to network and get out there and not be a dork. Whatever that means to people, I don't know. It works out for us usually, so do whatever we're doing, I guess.
I know, you're pretty dorky sometimes.
Nah, I mean, I definitely be a dork, but like, I don't know. You know what I mean? You at least have to be your own flavor of dork, and how about this? Don't be a douche.
Yeah.
And make it easy to Mike's point to work with. But also having single channel risk is any business has that. So you got to be careful on how your supply chain works. And for us to have a supply chain that has multiple outlets works, but also for what we're doing, which is basically, we use our own capital and raise capital, where some people don't have that ability or choose not to do that. That at least gives you an option that you get to control the money and control the yield, and somebody can't shut it off.
Yeah, for sure. I will say that from a big picture, it was like most people there were generally pretty bullish on the sentiment around real estate and how they're kind of like looking at stuff, cautiously bullish. Like there was very little, like I would say, doom and gloom talk like you sort of are seeing in like the real estate space in like the finance world.
I'll give you my take on that is in rooms like that, everywhere there's a salesperson, and that shit will turn in 180 degrees in a minute flat.
Yeah. I mean, yes and no. I mean, even talking to some of like the bigger heads though, they were all pretty optimistic.
All those people are incentivized by transactions though, right?
That's true.
They need it to be optimistic. They need us to think it's optimistic. So we need Dylan to think it's optimistic so we can keep rolling that up to the shit show. But the minute that dude that's got $3 billion in a fund is like, I'm not feeling good today.
Yeah.
I don't like what Trump said, or I don't like whatever China's doing. I think I'm going to pivot and move over here.
Yeah.
Becomes once they have more opportunities somewhere else.
Yeah. Well, I also think there's an element of where they're just like so big, they have more room to fail, right? Because that's something also that's different about a lot of these funds is, say they have $100 million, bigger than that, let's say like $500 million, like $1 billion. They're going to have a rate of failure on their balance sheet, but that's also expected. Whereas I feel like as a real estate person, you typically are always going to be, let's say you own 100 houses or 200 houses, and you have some of them that are like an absolute dumpster fire. The problem is that becomes a compounding issue over time. Whereas with debt, it kind of doesn't. You can just kind of be like, whatever, just write it off because you're making so much money everywhere else. Versus like with a house, if like say 7% of your houses in your portfolio are messed up, that can lead to more issues. That can lead to your debts lapsing, right? If you can't pay your mortgages or you're having to pull from everywhere else to pay your mortgages, that can lead to like your tenants trashing the houses and more issues. It can lead to penalties from like the city if you're getting fined for your houses not being livable or things like that. Versus with the debt, you kind of just like find somebody else that wants to buy it, even if you sell it at a discount.
Yeah.
Which is an easier thing for people to do.
The risk of going to zero is probably a lot less, is what you're saying.
Yeah, it's marketable.
The risk of going to zero is honestly zero because you always have an equity piece in whatever the property is.
Which is interesting because, that's why we haven't ever paid attention to it, but there's a distressed debt market. We know note buyers. We have some in the scale community that have, talked about buying notes and stuff like that. And so, people are willing to offload it. It's almost like knowing that it's like when you're on your Robinhood app and you're like, I'm going to sell this at a loss so that I can go buy my, Mazda 6 car or whatever you really care about.
Yeah.
And, people might do that because they need money. And so same thing with debt is like, hey, I have a better opportunity for my $100,000 note. I'm going to sell it for $80,000.
Mm-hmm. Yeah. It's a much quicker transaction too than selling real estate. On some of our debt trades, we'll go and send it to our buyers and they'll be like, cool, sounds good. We'll send you the money tomorrow. And that's it. But that's the thing is weird is they give you the money and then you actually do the transaction, send them the collateral afterwards because it's so fast. So it's like imagine if you sold a house, Dylan, and the second they sign the PSA, you toss in the keys and then they pay you in like 45 days.
It's a bit different.
It'd be very weird. Yeah.
Right. Yeah. So this is actually a different thought. While you were talking about that, I was thinking about this. So talking about like what we're talking about is like assuming there's liquidity in the debt markets, it's easy to trade notes, right?
Yeah.
And if there is a liquidity issue in the private debt markets, like we had, I guess you would say in the 2009, financial crisis when basically housing and everything went crazy. If you had that same crisis in the private market, does that really trickle over into the public markets, if at all? Because say Dylan, who's a real estate investor who's built up some wealth around this, has 50 houses, all private debt against them, and he is now distressed. And Dylan loses 50 houses. Sucks to be Dylan. But 50 people didn't lose 50 houses. One person lost 50 houses. And the people that live in those houses will likely keep living in them.
Maybe. I mean, it depends, right? Like if they all go to foreclosure auction and they get picked up by wholesalers or house flippers to go and kick out all those people.
Well, that could happen too, of course. But fundamentally, those would stay as units, right?
Correct.
Fundamentally, you'd think, right? I don't know. But, that's why I'm just kind of like thinking about the private credit market as like a separate market. And all these real estate investors I mean, Dylan probably owns several houses that people lived in at some point in time that know that maybe for some reason can't afford to live there anymore because of affordability issues or financial issues or whatever. But we're only affecting Dylan's wealth.
Yeah.
I think you have a point there. And back in 2008, there was like a lot of shadow banking that people didn't know kind of what was going on. They call them, was it non-bank financial intermediaries or something? They have a different name, but they're eventually the same thing now. But where my mind went was, what if there's a lot of, Dylans or Mikes or Dans, and let's just call it the upper 50% spend so much into the economy right now, but now those people can't spend. Mm-hmm. So it almost would be more systemic from GDP standpoint, because now they're not spending into the economy, right? Like, so.
Okay. Oh, yeah. Because they are the spenders, right?
They are the spenders. They're the vast majority of spenders. And now they're like, well, I'm
tightening up,
batting down the hatches. I'm not setting any. Yeah. Right. So that's where my mind went. I don't know, but I mean, from a moral standpoint, I think it's better if private people lose their own money, right? Other than it being a systemic risk to other taxpayers and everything. Right.
Yeah.
Yeah. But I mean, capitalism doesn't always care about morality. That's like the least of the issue there, right?
No government cares about morality.
No government. That's true. That's fair.
What are morals?
Right. I mean, morals are really just a construct. At one point, we were killing each other with rocks because they're from a different tribe. It didn't even, their politics didn't matter. They just weren't part of my family. So I'm going to kill them.
Exactly.
But I think too, what's interesting about that as well is if you look on an average place, Dylan, upper class, 1% to 2%er, the difference is that if things go sideways, if you look at Dylan in the 1% to like, let's say Dylan's in like the 1%, like that range, like the range is now 1% to like 0.1%. Dylan's at the bottom of the totem pole.
Yeah.
Sure.
Dylan is you are the poorest rich person, right? You are the tallest dwarf, as they say in Succession, right? You're in like the worst position. And even though you're in a better place than everyone else below you, when they have actual leverage on you, you're completely screwed and there's not a lot you can do about it. Mm. And so that's the group that would end up getting bit the most if things go sideways, because fundamentally you would be the quote unquote middle class.
You stand to lose the most, like
totally,
literally.
You stand to lose the most on paper, definitely from like a net worth perspective. Mm-hmm. It'd be very, very hard pressing where our daily needs aren't met though.
Correct.
Yeah. Right? Yeah. Of course. Yeah. It just hurts. It just hurts when you look at your Excel spreadsheet.
Yeah. It hurts your ego. I had a mentor a couple of years ago who had he had a year where he made $7 million. And that current year that I met up with him, he had made $1.5 million. And he's like, you know what the worst part is about going from making $7 million to $1.5 million? And it's like, no, he said, well, your life doesn't really change, but nobody feels bad for you.
I mean, he's right.
Yeah, totally.
Yeah,
right.
He's right. You know what I would do? I just go get some 50-year mortgages. That's what I would do.
Oh,
seriously, what's your take on that? I would say one of the biggest things that I've noticed as this whole conversation around 50-year mortgages has been all over my social media is how incredibly ignorant people are to how amortization rate works.
Yes.
Right? As they're trying to like explain all this different stuff with like how the interest pay down is calculated. And also how people just generally don't understand math. Like at all. Not even just like people, like quote unquote people that are in your Facebook group, but people that are like freaking financial gurus are posting shit. I'm like, that's not how it works, dumbass.
They don't know shit. And, it's dumb.
The first thing is if you're getting a 50-year mortgage, your interest rate is going to be higher than a 30-year.
Of course.
The payment between those two things is not going to be that different. Like $50 a month on a $350,000 mortgage.
Right.
And so obviously it's all front loaded on the AIM scale. I think if you're an owner occupant, it's more than likely a terrible idea. Now, if you're an investor and you cash flow and you're like, my whole thing is cash flow and I don't care about everything else, then sure, you can make a case for it. And if you're going to invest the difference in the S&P 500, but no one's going to actually do that. That's the other part. It's like the practicality behind it. So all in all, net negative.
The challenge, I think, is like people, and this is where I feel like this is such a stupid pitch for brokers, like the loan brokers that do this, is like, over time, this is how much interest you pay over 30 years. It's like, who cares? What is it relative to rent? Mm-hmm. That's what you got to think about. Yeah, now, obviously, an interest-only loan is a totally different loan than a 30-year fixed. Between, like, okay, you're going to do a 50-year loan, you're going to pay this much more in interest, or you're going to do a 15-year, and you're going to pay this much less in interest. Like, at the end of the day, what is it relative to your other places to spend money? And that is rent.
Yep.
Mortgages tend to be about the same within a reasonable percentage of what people can pay for rent in a comparable home. Mm-hmm. And so that's really what it matters. And so doing a 50-year, the only thing that does is continue to drive inflation because of the way the American economy works is naturally people will just still end up paying more for housing.
Yeah.
And then rental rates will go up with it, and it'll just kind of do this. It has nothing to do with how much interest you're paying. Doesn't matter how fucking long the loan is. It just matters that you're giving another opportunity for wealthy people to add additional wealth.
Yeah.
I.e. the banks.
Well, I think they've mostly moved away from the whole sales pitch of this is how much interest you're paying over X period of time, because that's like what boomers cared about when it was like.
I still hear it though. I still see it. It's so stupid. The 15 year is not even an option anymore for people. So I don't think you hear, like when I was first buying houses or when I was first coming in my 20s, like 15 versus 30 was a real conversation people were having.
Totally.
Now it's not even an option.
Well, it's because the prices were lower, and ultimately when you buy a house, right, you're buying the monthly payment. That's what the average person is buying the house for. But when I bought my first house in 2015, I had that same conversation with this is how much interest you're paying.
Right.
But I think it's because that was kind of the end phase period of time where a lot of the home buyers were people that were career people that had 401ks, and they're like, I need to save $1.3 million so that I can retire comfortably.
With my paid off house.
Yeah, and they would say, if you paid it off now, you would have an extra $450,000 at retirement.
And coming out of the 80s with high rates, I could see also why people would tend towards that.
For sure. But like they weren't considering, well, what if they instead just like took money and put it in S&P 500, put it in their 401k, put it in whatever. They're not considering any other forms of growth.
Right.
It's like when like buying stocks and stuff online was still a little bit janky. You had to do $10 trades on freaking TD Ameritrade or whatever. Right. And so a lot of people didn't do shit like that. But now it's just the entire ability to generate money through investments. The opportunity cost is much higher for people. And so I don't think you really hear that unless they are super old school or they went to like the whatever loan broker school that is no longer relevant. It's like similar to like how a lot of realtors, they will have these different sales pitches around, I don't know, like what if freaking realtors pitch, Dylan?
It's the marry the house, date the rate. That's my favorite one. Yeah.
That was pretty ignorant.
Marry the house, date the rate. That's like a good one. It's just so like short-sighted, right? And it's so just like, obviously they're incentivized you to do a transaction today. It's the same with like the mortgage brokers that are kind of pitching that. But like if you look at the big picture, what people are really buying is that monthly payment. And so talking about this 50-year mortgage, the reason people are talking about it is because they're assuming what Dylan just said is that the rate would be exactly the same, but now it's over a 50-year amortization, which would never happen. Even if they offered this as a product, it would probably balance out where the monthly payment would be exactly the same. It's just now you're going to be front loading more interest on it. And so it would really change nothing.
Yep.
Well, it allows for prices to stay high in the same interest rate environment.
Totally.
Right. So if nothing changes in this interest rate, then prices have to go up. If prices don't go up, interest rates go up. It's like, again, it's going to cost you the same amount every month regardless. And it's just going to cost you more over time.
Well, they did that. Plus, they're getting rid of that minimum 620 credit score.
That is the equivalent of us having the conversation with the lady talking about the 500 credit thing.
Why would you do that?
Like, that's freaking nuts. Dude, history doesn't repeat itself, but it often rhymes. Like that is the epitome of like the no-doc ninja loans.
Because like there's like an issue with credit scores. What is the claim?
I mean,
are they racist?
They've got to prop something up. No, I don't think that's it. But you got to keep propping it up. And if you want to, like, we've talked about on the show how many times housing and how many different sectors it touches, right? And so they want to keep the train going. And then to keep it going, you got to loosen the standards until it all comes crashing down, which who knows if that'll actually happen.
Yeah, that is the 2025 version of the ninja loans, the no income, no job loans.
Yeah,
right. 100%.
Right.
The no credit, no money loans.
They did see the portable mortgages thing, which I don't think this will ever pass. I actually think it's a decent idea. Whereas, like, if I have $250,000 at 3% left on my mortgage, I could go apply that to a new mortgage, right?
I like that.
But the banks would never agree to that because they're like, well, I want him to pay off that 2.5% mortgage, so I get a 6% mortgage, so that way I can make more money. And how much lobbying power the banks have, I just don't see that going through. But I do think it's a good idea.
What they would do is if they were good at sales, right, is they would say like, well, we need to get you, like your blended rate needs to be at the rate that we want. So we're going to sell you the second mortgage at 8.5.
Right. Regardless. Yeah.
So your blended rate's going to be 6.25, but it gives you more buying power to give more debt with us. That's what they should do.
But still, is that any different than what's being offered today? Like, yeah.
Absolutely. Because basically what's happening now is that bank is getting the $250,000 from you at a lower rate that they're basically now able to make you pay, and they're just getting money at that.
Yeah, right. So, but again, who wins here?
Yeah. The people at the top, not the consumer.
The lender, yeah.
Yeah, the consumer never wins in debt at the end of it.
I guess it's be like, I have $250,000 left at my 3% mortgage. I want to go buy a $250,000 house with zero debt. Like that's something, like you'd have to make an even trade.
Yeah, that wouldn't work. You'd have to be like trading up. Be like the consumer version of a 1031.
Yeah, actually, that's a good analogy.
The There we go. We just came up with a new financial product, you guys. We can call it the, what do we have? I'm trying to think about a DDM. We don't have a good alliteration for our.
We'll report back next week.
We'll report back when we have some time to think about this. Mike just got back from Vegas. He's got brain fog.
Dude, fucking the cigarette smoke, man. I'm never staying in a primary hotel on the Strip again because I just can't.
It's pretty bad.
Deal with it. Dude, my throat was wrecked until I got home yesterday.
Mine too.
Do you chain smoke some cigs when you're out there?
No, dude, just being in the casino where everyone is smoking cigarettes.
I mean, I did have a cigar.
You 3 cigars.
So I mean, I can't complain too much, but they were really nice.
Well, the last couple times I went to Vegas, I stayed up north in the Fontainebleau and Resort World, which is those are more resorty hotels. And up there, they're a little classier. People smoke vapes like an adult. They're not ripping ciggies. They're smoking their blue raspberry fucking douche flute. Yeah, and it's just a better vibe. It's a better vibe.
Yeah, it's a better vibe. You're right, though.
You guys are turning into true finance bros. That's what I gotta say.
Oh, I actually got a Patagonia vest coming in the mail, a Buffy. I'm excited to start wearing it.
It's got SLA Capital embroidered on it. We have talked about that. We do got to get some finance pro vests.
Those actually are pretty nice vests, though. Those custom ones I could order. I know we might need to. Dude, Chance with the. Oh,
he'd be great.
Puffy vest.
Dude, that was a good story when they thought we were cops. Oh my
God. Our sales guy, works out. Fit dude. He's got mustache,
slicked back hair.
He's got a style.
He's a porn star, is what I'm hearing.
Mm-hmm. Basically,
for sure. It's a very universal stash.
Yeah, but he went to the bathroom at there's a quick story here, then we'll wrap it up. Went to the bathroom at the first restaurant we went to on the first night, and he's in there washing his hands, and this other guy in there, and he just goes, "What's up?" And Chance is like, "Hi, man, what's going on?" He goes, "Are you guys cops?" He was like, "Oh, what do you mean?" He's like, "Our friends aren't talking. We think that you and that bald guy, you guys look like cops."
It's just the military and Dan coming out.
Yeah, exactly.
And he's like, no. And then he said the Chance is like, "If you come over and you tell all my friends that you guys are cops, it's like, I'll buy you a round of drinks." So then Chance went out there and he goes, it's like, yeah, we're cops. Basically, this whole thing, I guess, was these 3 Italian guys. And I don't know, I'm assuming they were up to no good if they're really worried about these cops that were sitting at the table over.
Cops, yeah.
No, I'm not a cop. I do cocaine right now.
Also, Chance looks like a dirty cop. So
he does.
That's probably why they're probably, what are these guys up to? Are they undercover?
That was our joke for the whole weekend. It was like, dude, lay low. People are going to think you're going to bust them for something. But
that's hilarious.
Anyways, cool guys. Well, thanks for listening, everybody. Hopefully you enjoyed finance talk on the real estate show. Lots of good stuff. And I would say big picture, there is a lot of, I won't say innovation. There's a lot of dynamic movement going on in the financial space that is becoming more and more hungry for different kinds of real estate deals. And so just keep inquiring with your lenders, keep reaching out and talking to people. And there's probably deals that you'll find relatively quickly that weren't always financeable that will become financeable relatively soon. But you got to have good credit. You got to have money. You can't be a schmuck unless you want to get one of these 500 credit loans, in which the case some Russian guys are going to steal your house and you fail anyway. So right on, guys. Besides that, go to collectingkeys.com. We opened up our scale community a few weeks ago. So you can go and you can join that, hang out with us in the Slack channel over there, as well as the other members. Come talk real estate. Come and see the 4-ish years of wisdom that we have in there of conversations around building your real estate companies. And you also chat with me and Dan and Dylan as well. So just collectingkeys.com. You can sign up there.
If you want to learn from SLA Capital, I have a referral code you all can use.
Yeah, use Dylan's referral code. Yeah.
Oh, there you go. If you hit us up and say that you're applying because of Dylan, Dylan will make a few bucks. So that way he can afford to pay for his fancy new BMW payment.
Yeah. It's an Audi, bitch.
Right. Oh, Audi.
Is it an Audi? Oh,
yeah.
Shit. Sorry. But whatever. Same car. Anyways, guys, have a great rest of your week, and we'll talk to you guys next time.
See ya.
Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorManDan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.